This is Spencer with Numbers Up Finance, and today we're going to have a quick tutorial video on what are divergences, both bullish and bearish divergences, and how you can use them to improve your trading ability. So to start off this video, let's talk about what a divergence is. And by definition, a divergence is when two things move separately of each other. And as you would expect, that applies very closely to what a trading divergence is. So basically what a divergence is when the price movement is an opposite of a momentum indicator. That's as simple as I could probably explain it. And there's a whole slew of momentum indicators. My two personal favorites are the MACD and the RSI indicator. They're also probably the two most common used momentum indicators. And so getting back to the divergence, what a divergence is when the price is moving in the opposite direction of one of these momentum indicators. You can see here that we're starting off with a chart of QQQ, which is the NASDAQ 100 index. Well, it's the ETF for the NASDAQ 100 index. And you can see here that just recently in the past couple months we've had a very strong bearish divergence. And so what a bearish divergence is, it's when the price continues to make higher highs, as you can see here, for a couple month period, but the momentum is slowing down or decreasing, which you can see very clearly on the MACD and the RSI that the momentum is going down, but yet the prices are going up. Now, an important thing to know about divergences is that they're not a buy or sell signal by themselves. And basically the reason for that is that divergences can be extended or they can also be foiled. In this case, you can see that the divergence was extended numerous times, right? It made a higher high here while the momentum was lower. You wouldn't sell here just because there's a divergence. There's a bearish divergence here where the momentum is downwards, even though it made a higher high in terms of the price. But it kept building up. It kept building up momentum to the downside for the momentum, and the price continued to go up until it finally breaks. And usually when they break, they are fairly significant. And so this first example, this is just on the daily chart for QQQ. You can use them on numerous different time frames. My personal most frequently used time frames are the 1 hour, the 1 day, and the 1 week charts for divergences. The longer the time frame you go, the more the more apparent, and usually the longer term the actual swing is that you're expecting. So next up, I've got an example of a longer term swing that you can see using these divergences. This is USO, so it's the United States Oil Fund. It's very closely tied to crude oil futures. They're basically identical charts, just a little bit different in magnitude. But so this is on a couple year week chart where each tick, each bar, each candlestick represents 1 week in trading. And you can see both a bullish and a bearish divergence on this chart, so I'll go over those. We'll start with the bullish back in 2014, and you can see that on the weekly chart, this took an entire year for this divergence to build up, where the price continued to make lower lows, the price was going down, but you can see the momentum indicators are going upwards. And once it finally popped, it popped in a very significant way. There was about a period of 100 days where it was up 65%, which is incredibly a significant swing. And quite recently, we've seen a bearish divergence on the weekly chart for USO. We saw for a period of about, give or take, 9 months or so, where it was making higher highs, but the momentum was going down. Now, it's a little bit hard to see the momentum on the MACD for this one. If I were to zoom in on this on a daily chart or even just the weekly chart and expand the MACD, you could see it quite clearly. But the RSI shows it pretty clearly where the momentum is going down. Typically you want to have numerous different things line up for the divergences, right? Because all the momentum indicators are slightly different, and so when you get numerous different momentum indicators telling you the same thing, it's generally a signal that the divergence is real. There will be times when you can get maybe not different signals for the different momentum indicators, but sometimes one will be telling you that there's no real up or down momentum, and while the other one will be saying that it's a very strong bearish momentum. And so usually you like to see those overlap, which most of the time they do. But getting back to the analysis, right, so you can see that the prices are making higher highs as indicated by this line. The momentum's going down, and once it breaks in a very significant way. This one was down 80 days and 40%. Well, it wasn't down 80 days, but over the course of 80 days, it was down 40%. And so that brings us to the question, how can you trade using these different divergences? And there's a couple different ways you can do it. The first and most obvious way to do it is just to avoid unnecessary risk. And the most general way to explain that is basically if you see that there's a bullish divergence developing like we had back here in 2014 where momentum's going up but the price is still going down, it might be a time to either get out of the shorts that you were in previously or certainly not to add to new shorts depending on what time frame you trade on. But usually these divergences, especially the ones that are on the more macro scale, you know, the weekly and the daily charts, sometimes even the monthly charts, but those are very extreme. But usually these big macro divergences that you see are signals that there's a pending reversal. And if there's a pending reversal, while you might not be able to predict exactly when it's going to happen using the divergences, you know it's going to be coming sometime at the future, which, you know, it all depends on what kind of trader you are. But for me personally, when I see a divergence, that's a signal for me to either start scaling into a position or out of a position, depending on whether which way the divergence is pointing. Alternatively, and I do use this method quite a lot, what I do is when I see a nice macro divergence like we have here on USO for the weekly charts, I'll look for technical analysis or a buy signal that indicates that I buy long, right? So we saw here there's a bullish divergence. So even though the price is going down, you might not want to be going into a long position until you have a very concrete buy signal. Because otherwise you're just catching a falling knife, and that is one of the quickest ways that you can get your numbers down in trading. And there's a bunch of different buy signals. It depends what the charts are like. It depends what kind of trader you are. But let's look at, so this is the same USO company that we were looking at previously on the weekly chart, where you see this big spike upwards, 65%. But this is on the daily chart, but this right here is the same exact time frame that this right here was from. It's just with the 1 day charts. And so looking at the 1 day charts, there's some pretty nice buy indicators here when you look at it on this time frame. The first thing I'd like to point out is that on this time frame, on the daily time frame, we also have a bullish divergence. We have a lower low, but the momentum was very much so pointing upwards. And so another thing that is a very commonly used buy signal is price and volume action, right? So right here we had a bottoming candle. And quite frequently what you'll see with either bottom candles or candles that are at the top of a reversal is that they'll often have these long wicks at the end. Like you can see here, it's not a terribly long wick, it's more apparent on other charts, but it's still present here, and it's very significant, especially when you line it up with a very increased, a big spike in volume that day. Generally, people consider that to be what's called a selling climax, where you get a lot of selling intraday, but then at the end the bulls close it out, which is exactly what you see here. So there's a couple things lining up, right? You've got a MACD crossover, your bullish divergence on a smaller time frame. You've got it's called the Doji Candle. It's not quite a Doji Candle. It's got a little bit of an extended body to be a Doji Candle, but you can see the long wick at the bottom indicates that it was a bottoming candlestick. And so in the case when you're looking at this weekly chart, and you can see that the very macro trend is it's calling for an imminent reversal, and then you get the smaller time frames with either the 1 day or even sometimes the 1 hour charts that you can use, and that stuff all starts to line up. That's a very strong time to buy. And in the case of USO, it was a very strong time to buy. Over the next couple of months, you would be up 65% on that trade if you held it all the way to the peak, which obviously is just not feasible, but for the purposes of explanation, that's what we have. And so if you like this video, be sure to leave a like, subscribe. Any comments, criticism, or anything else will be greatly appreciated. Until next time, make sure you keep your numbers up.